This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Investment insight from Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Welcome to the Wealth Roundup for the week of April 10th, 2026. Happy Easter and all that. Now that it's gone, Patrick, time to get ready for spring and really plow into it. But there is one thing about the markets that I wanted to ask you. When I open up MSN, it's basically the news service. And
Yep.
then you can go into your global market page, open up the S&P TSX Composite Index. And I was looking at, usually we look at 1 month, 3 months, year to date, whatever the case may be. But I scrolled down and underneath the day range and the 52-week range, I saw the 1 month return at 0.13%, 3 months at 3.08, 6 months at 9.14. But the 1 year return, the S&P TSX is up 44.91%. Do you ever look at that? Is that ever something that makes a difference as to what your daily sort of routine is and how you deal with your clients?
Yeah. So you're talking about the TSX. So this is the Toronto Stock Exchange right
Right.
now that you're looking at,
Mm-hmm.
and I would say for 1 year period. So if you just take say 2025, is that the rate of return on the S&P TSX 60? I don't have the exact figure, but I would have to say that in terms of calendar year performance, since Standard and Poor's has been tracking Canadian stocks, is that it's probably in the top 5% of all time returns for the Toronto Stock Exchange. And we've talked about this on some of our past podcasts about the TSX and its extraordinary year, but how narrow the market was in terms of where those returns come from. So important to know how these indexes are created. So the S&P stands for Standard and Poor's, and Standard and Poor's would be for lack of a better word, a kind of like a consulting company, kind of a financial institution, and renowned for putting together, various benchmarks to cover off things like bonds and stocks. And so the idea is that the index is to give you a representation of the Canadian stock market, and usually has something to do with market capitalization. So the number of shares outstanding multiplied by their share price gives us an idea of the value of a publicly traded company's value. And so the Toronto stock market is very much dominated by banks, resource companies, and then to a lesser extent, things like information technology, manufacturing, consumer staples, just like every other market. So how the TSX would say differ from, say, the S&P 500, the US market, is that the US stock market right now today would be very much defined by the big hyperscalers in the information technology space. Probably makes up close to 35% of that market. Whereas in the Canadian market, the banks, the financials make up about 30 to 40% of the entire market. And so last year's really strong performance came off of a very good year for the Canadian banks, which make up a big part of the index, plus a very good rate of return for the gold mining companies that trade on the Toronto Stock Exchange. Now, the gold mining companies, they make up a much smaller percentage, but if I'm correct, the rate of return off the Canadian Gold Miners Index last year was 170%.
Wow.
And that's obviously on the back of gold prices, which have done really, really well. Now, you would have had lots of other sectors that would have underperformed last year. Energy wasn't a great performer last year. Transportation wasn't a great year. Manufacturing wasn't a great year, i.e. the auto sector being affected by tariffs. So a very good year coming off of a couple kind of lame years for the TSX. If we were to look at that average rate of return, same thing off of your MSN quotes, and then go and look at the TSX 60, is that last year really helped that 5-year number. But my guess is that 5-year number for the TSX is probably very close to its long-term average, probably pushed it into about the 8% range. over the last 5 years. So quite volatile, but kind of shows the cyclicality of the Canadian market and how maybe dependent we are on things like oil and gas and finance, much like the US market has been very dependent on technology.
Okay, what about a market update with a bit more narrow focus from a week to week sort of thing as we've been doing?
Yeah, so I think the key thing is, and should be all that surprising, is everybody's in this wait and see. How is this thing in the Middle East going to turn out? And the markets are somewhat reflecting that. Is that whenever they get any kind of a hint that maybe there's going to be a ceasefire, maybe there's going to be an end to this, the markets kind of pop up, right? So it's been a lot of kind of give and take, but I guess that there's been a little bit more give than there has been taking since our last podcast, because both the Canadian and the US stock market are both up about 2.5% over the past week. They're flat today, but whether or not that was President Trump addressing the world in a kind of a prime time speech last week, I think it was on Wednesday or Thursday night last week, gave the market some hope that there was at least some conversation in the background. We don't know. We don't have any insight. I think we'll just kind of continue to kind of focus on the long term with respect to the markets, and so we kind of look at a couple things that we normally also update. Gold prices. Gold prices firmed up a little bit, so we're trading around $4,600 an ounce. So that's up a little bit. We're still down off the highs, well off the highs on gold. Bitcoin also has kind of come off its highs a little bit, but kind of stable for the last week. So again, wait and kind of continue to wait and see. Investors in terms of where their expectations are at. Wouldn't surprise me if this has continue to make investors a little bit nervous.
Okay, let's look at buying the dip. I can't open my Twitter app without seeing somebody post hashtag buy the dip.
Buy the dip. Yeah, buy the dip. So I think, buying the dip is for investors whose risk tolerance hasn't changed through this period of time. For investors whose time horizon still continues to allow them to invest where they don't need this money for 3, 4, or 5 years, so they have time. Buying the dip, I think, becomes a really good way to make your money work harder for you, because stocks that you really liked a month ago, they're cheaper. The S&P 500 is down about 4% year to date, probably close to 10% off its highs for the year. Those stocks are at a discount. So, but the key thing here is, this type of market really kind of tests who you are as an investor and how comfortable you are with risk. And so, this is, this Warren Buffett has this great quote. Be fearful when others are greedy, but be greedy when other people are fearful. It's awesome. It's a great quote, and it really kind of goes and talks this idea that if stocks are cheaper, and especially the stocks that you like, the businesses that you like, then yes, going and buying the dip makes sense. Now, we also talked about that our firm had put out a webcast, just kind of putting into context, volatility in the Middle East. And that podcast is we can send out the link, but it's also actually now available on BMO's YouTube channel, so it's available there as well. But if clients want to reach out to Katie or myself, and we can send you the link. But just a couple reminders is that we had a really good start to the year. If we kind of take ourselves to where we were in February, really good start to year. In fact, probably a little bit ahead of our expectations. We went into this crisis with actually probably an oversupply of oil. And in fact, we've recently kind of updated some of our commodity prices, and unsurprisingly, we've increased our forecast for the average price of West Texas Intermediate for the year to about $80 this year and $70 next year. So those are increases for both years. What's surprising to me is we've actually lowered our forecast for natural gas. And the reason for that is that even with everything going on globally, is that we still have too much natural gas here in North America for what we need. And so we obviously have to find a way to get that to market. But it just goes to show that even while, there's an energy crunch, what appears to be an energy crunch globally, is here in North America, we still have a glut. And so, I think we're also going to find in a couple of weeks, we're going into earnings season. It's going to start with the U.S. banks next week. Is that don't be surprised if all of a sudden we run into an earnings season and the past quarter is going to show earnings were pretty good. Now, with that, I wouldn't be surprised if many publicly traded companies come out and they sandbag to a certain degree what their earnings expectations are for the rest of the year, meaning they always provide us some guidance, and they will probably talk about the events in the Middle East, providing some dark clouds of uncertainty in terms of what the global economy can do for the rest of the year. But I fully expect earnings to be very good.
I just have one thing about buying the dip. Is that something that is more relatable to somebody who is doing a self-administered investment stuff, or is that with someone who's got a portfolio manager such as yourself?
So I would say a couple things is that self-administered. You're going to see a certain percentage of investors that are quite savvy, but you're also going to find probably 90% of accounts that are in self-administered accounts are people that are unsophisticated investors, but have primarily opened up a trading account, maybe because they wanted to buy the stock of the day at the time. I think back when cannabis first got legalized in Canada, all the people that wanted to go and open up a trading account so they could go and buy, you name it, cannabis ABC stock. And they didn't think about diversifying their portfolio. They just wanted whatever the great, the most popular stock was at the time. And my guess is that probably 90% of those traders ended up losing money, on that trade. So, but within the DIY investors, you're going to find a number of sophisticated investors that are going to do that. Now, on the institutional side, and so that would be world of portfolio managers and pension managers and professional investors, they would do a couple things. Is that they would have a process that they would use for going and adding risk to the portfolio and taking risk away from the portfolio. So buying the dip while at the same time maybe selling on some really good news that has pushed stock prices maybe beyond target prices on both sides. That's an interesting thing about the world of investing is that, to your point, when you go on Twitter or X, is you have lots of alerts, must buy, must add, chance of a lifetime. But what you don't hear a lot of is, about selling. So lots of buy side advice, but not lots of sell side advice.
Mhm.
And sometimes selling is much harder than buying.
You talk about the cannabis stocks, and well, or you run into a buddy at a bar, and he's got a cousin who has a friend, and they
Yes.
have this thing that you got to get in on.
Yes. Yes. So yeah, exactly. It's and we talked about this, in investment psychology, this fear of missing out.
Yeah.
It's really powerful. It's really powerful. And then if an investment doesn't work out, is this reluctance to sell. Like, what if they're able to turn it around? You know,
Mhm.
that's a dip that's you have to be very cautious about buying in.
Yeah.
Is looking at your cannabis stock, which is down 90%, and it's so cheap. But I heard they're going to turn it around, right? Or I heard somebody from the Middle East is going to come in and buy out the whole company. Yeah,
And
so buyer beware.
what's a covered call? Is that something that a portfolio manager deals with a lot?
Yeah, so covered calls are an investment vehicle that they're not new, but they're new to some people. And so the idea of a covered call, usually when we're talking about covered calls, we're talking about covered call exchange traded funds or covered call ETFs. This type of investment uses a strategy called options. And in this particular case, is that we, or BMO in this particular case, say with a BMO covered call exchange traded fund, is that the portfolio manager in this particular case has a basket of stocks, which they really like. And let's say it's Canadian dividend paying stocks or US dividend paying stocks, or maybe it's a sector like Canadian energy or Canadian utilities. And so we have a basket of maybe 25 to 35 stocks. And then we enter into an agreement, which we call an option, where we are writing options or selling options to a third party to buy a portion of the stock that we own at a predetermined price over a predetermined period of time. And so on the other side of this trade, there is somebody that believes that the stock that we own is going to go higher. And where they hope to benefit is to agree to be able to maybe take our stock, let's say on Bank of Montreal stock, which is trading at around $90 a share right now. And they're hoping to go and buy it at maybe 120. And so we enter into agreement to say, if the stock hits 120 over the next 60 to 90 days, we will sell at that price. Now, they're hoping that the price goes beyond that price. So they're hoping to control a basket of shares. They're usually in blocks of, say, 100 shares. For a smaller dollar amount than it would take to go and buy the whole 100 or by the whole 100 shares of that stock, which it would cost in the tens of thousands of dollars, right? And so in reality, most option agreements expire worthless to the person who bought the option, meaning the stock never goes to that higher price. And people investors who that's their investment strategy of buying options, they will then probably go and just buy another contract, continue to do this until the trade works out. How it works for us as being the holder of the portfolio and going and writing these options is it creates an additional source of income to the investor. So if we think of the BMO ETF, US high dividends, I believe the symbol is ZUD, is that right now the effective dividend yield on that portfolio of US dividend paying stocks would be just under 2%. So that would be what the yield would be. On the BMO covered call ETF for US dividend payers, the current dividend yield is actually closer to 5.6% because of that increased income. Now, there's a trade-off, is that I often advise clients to say, while you're collecting more income right now, you're probably giving off some of the top end return. So if we would expect that basket of underlying stocks in the uncovered call to, say, earn 9 or 10% over a full cycle, is that I usually say, on a covered call strategy, expect that you, in terms of your total rate of return, you might only get 80% of that number. So not quite the full amount. But what you are getting is you're getting more income right now. For certain investors who want this combination of growth and income, is that we have an investment solution that more reflects their investment expectations, kind of that perfect investment for them. Whereas other investors who have a much longer time frame maybe don't need the income, in some cases don't want the income because it might not be favorable from a tax situation. All they want is the capital gain, then maybe a covered call strategy isn't perfect for them. But I think what it shows is that the investment industry continues to go and find niche products that kind of fit clients. And so when I think of, a lot of our clients are either retired or are about to retire, and going and finding a way to get income from their portfolio, we already talked about how difficult it can sometimes be to sell your investments. It's like picking your favorite child, right? Yeah. Is that which one of these things am I going to sell? Well, these covered call strategies, they almost kind of take that selling decision out of your hands, by going and giving you a higher level of income. Yes, maybe kind of at the cost of giving off some of the top end, but now finding this regular source of income from your portfolio. So certainly an idea, if our listeners are interested in and want more information on, to reach out to Katie and myself, so we can talk about that and see if it's a good fit.
For information on that and for wealth management and to start your investment journey, you can find Patrick and Katie's contact info at www.patrickmleonard.com. And that wraps up the Wealth Roundup for the week of April 10th, 2026. Thank you very much, Patrick.
Thanks, Terry. Have a good week.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.